the Bank of England's Monetary Policy Committee, MPC, recently voted to reduce the bank rate by a quarter point to 4.5%, a decision met with dissent from policymaker Catherine Mann. Mann, along with one other member, advocated for a more significant half-point reduction, a stance rooted in her assessment of the current labor market dynamics and their implications for inflation. She believes the softening jobs market will curtail wage pressures, thereby mitigating the anticipated inflationary hump projected for this year. Mann's dissenting vote underscores a divergence in perspective within the MPC regarding the appropriate monetary policy response to the evolving economic landscape. While the majority opted for a more cautious, gradual approach, Mann's argument hinges on the expectation that a weakening jobs market will act as a This contrasts with the MPC's central forecast, which anticipates inflation climbing to 3.7% by late 2025, largely attributed to escalating energy costs, coupled with increases in water bills and public transport fares. Mann's outlook, however, suggests a less pessimistic view. Her position, encapsulated in her phrase, "Don't be dismayed by the hump yet," indicates a belief that the inflationary surge will be less protracted and severe. This divergence is further illuminated by Mann's interpretation of recent economic data. She cites survey data indicating that numerous companies are planning workforce reductions. These planned job cuts, she argues, are a direct consequence of several intertwined factors. The prevailing overall economic slowdown is a significant contributing element, alongside the recent increases in the national living wage and the impact of the autumn budget, specifically the rise in employer national insurance contributions. These combined pressures, she posits, will create a less competitive labor market, thereby diminishing workers' bargaining power and limiting their ability to demand higher wages. This suppressed wage growth, in turn, is expected to exert downward pressure on inflation, counteracting the anticipated inflationary pressures from energy and other price increases. Therefore, Mann's argument centers on the belief that the anticipated inflationary surge will be self-correcting, largely due to the dampening effect of a less buoyant jobs market on wage growth, rendering a more aggressive interest rate cut appropriate. The contrasting viewpoints within the MPC highlight the complexity and uncertainty inherent in navigating the current economic climate and underscore the ongoing debate regarding the optimal policy response to manage inflation effectively without unduly stifling economic growth. The coming months will be crucial in determining whether Mann's assessment of the labor market's influence on inflation proves accurate.